How do you invest when the headlines are crazy? Well, here to talk with me about this is Dana Anspach from Sensible Money. Dana, welcome.
Thanks, Bob. Great to be here.
Great to have you. The headlines are crazy and getting crazier. Thoughts?
Well, I agree. Those are my thoughts. You know, but why? So I was writing a blog post the other day, and in the background now, there's a new tool that will do analytics on your content, basically to show you how well it will perform out there in the world. Will people see it? Will they be likely to click on it? And one of the tools is a headline analyzer. And underneath it, it says emotionally triggered headlines are likely to drive more clicks. So if you think about what's driving the headlines that we see, whether it's a podcast title or a TV clip or a radio show, they all need people to listen, to view, to click. They're driven by media dollars. And the analytics are out there now to show what is it we click on. Well, we click on things that have an emotional charge to them. And so you see bold predictions because those garner clicks. You see words like plunge and crash and tank. And anytime we're emotionally triggered, it causes this rush of chemicals in us. And think about like that constant bombardment of these different chemicals. I should be doing that. And I'm going to lose everything I have if I don't do this. And yeah, I absolutely think headlines are getting crazier. And it does make it more challenging to tune all of that out and try to form a plan.
Yeah. So what advice do you have for folks who are reading about recessions and inflation and interest rates rising, who are trying to navigate these markets?
It's the ability to step back, they call it zoom out, and stick to a set of guiding principles. And guiding principles, I guess I would equate it with exercise, right? If you want to live a healthy lifestyle on a fairly consistent basis, you need to exercise and eat healthy. You don't have to do it every single day, but you can't do it all in one day and then be good for the month. It has to be fairly consistent. And so when I think of guiding principles, it's really, what am I investing for? What's my time frame? Why have I chosen these investments? It's interesting for me when we hit bear market status just a few weeks ago, on the very same day, I can get a call from one client who says, hey, I think I've got some extra money on the side. I ought to put it in. They recognize this as a potential opportunity. And then I can get a call from another client that says, am I still going to be okay? And so it's the exact same market event, but two very different sets of emotions that are driving it. And so whichever one it is, it's going back to the guiding principles. For the person who says, I think I have a little bit of money to invest on the side, well, what's your time frame? What was this money for? How long are you willing to commit it to potentially see the results you think you might see? And for the person who's nervous, it's the same question, right? It really is the same. What are their guiding principles? And when we step away from those, I think that's when it can get sticky, and it can be easy to get sucked into what the latest headlines are because we don't have a plan, or we forgot about our plan, or we're not clear on the timeline of our plan.
So I sometimes think about guiding principles much akin to like an investment policy statement where you're establishing what you're investing for, when you'll be rebalancing, et cetera, et cetera. But how does someone go about developing a set of guidelines? Is there some easy ways to do that?
Yeah, I don't know about easy. I mean, it's like exercise, right? Is it easy? Well, you have to do it every day. I mean, or almost every day for it to be effective. So, but certainly there's questions you can ask yourself. Are you a trader? Or are you an investor? So if you were a trader, maybe your objective is to maximize your end of the day account balance. Well, that's a very different philosophy than someone who is investing for a 10-year time horizon. Are you going to use individual stocks or an asset allocation approach? If you are using asset allocation, are you going to use what's called a strategic allocation approach or a tactical allocation approach? And so just thinking through some of those things, whether you're watching Jim Cramer or some other stock tip, right? If you don't use individual securities, then you can tune out that advice. When you think about what's called tactical allocation, it has to do with moving your money from this sector to that sector, based on where the economy is in this economic cycle. Well, if you're using what's called strategic allocation, where you're putting X amount of money in each asset class for the long term, then you can rule out any of the articles that would apply to tactical. Are you a company or are you an individual? Most of the people we're talking to are individuals. Well, there's a lot of advice out there that is for people managing huge corporate assets, and they need to do things very differently than us as individuals. You also have your time frame. Are you investing based on a 1 year, 5 year, 10-year outcome? So how are you going to measure success? A lot of people measure success against a benchmark like the S&P 500. You and I have talked before. I don't like that. I think that's some arbitrary benchmark that has nothing to do with me or my household's goals. So if you have all those questions written down and answered, then you have a set of guiding principles. But I don't think in general that's the way people go about things. And unfortunately, it's not always the way advisors go about things. Some advisors are more of traders, they're more short-term focused. And so you also need to be aware, if you are working with someone, what's the philosophy that your advisor is following? What are the timeframes over which they're investing? And I could go on and on.
Well, share a story that you, with regard to your clients and these guiding principles.
Well, with regards to my clients, so I have a client who retired a few years ago, and every time the market went down, he would get very, very nervous. And yet the way that we invest is for 10-year outcomes. So if I'm investing for a 10-year outcome, we use a set of safe investments on the front end that need to produce the retirement paycheck for the client for the first typically 6 to 8 years of their retirement. And then we have a growth portfolio. And I think of it as my latest analogy, like watching the ocean tide come in. So I'm sitting here and the tide is in. And when the tide comes in, I have a bucket sitting there and the tide fills up this bucket. And then the tide goes out. And the next time the tide comes in, it'll fill up my bucket. Meanwhile, while the tide's out, I'm going to use this money that's sitting there in the bucket. I need to consume it. Well, every time the tide goes out, the market's down, this client would call me, "Oh, the tide's out, the tide's out. What if it never comes back in?" And so when I think about the guiding principles, a 10-year time frame, I feel very confident that the tide will come in many times over the next 10 years. And so it comes back to reminding people that right now the tide is out, but when the tide was in, we filled up this bucket of safe investments that you're going to use right now. And right now the tide's out and we expect the tide to be out. So that's the closest to a real life story. And, the other thing I see a lot are this kind of mixed set of time frames. If I was investing to maximize my account value at the end of any given calendar quarter, which doesn't make sense for most of us, that's very different than I'm trying to accomplish a result over a 10, or in the case of a retired client, over the rest of their life. So people aren't clear about the time frames that they're investing for.
Yeah. So you said it wasn't necessarily easy to create a set of guiding principles. How easy or hard is it to stick with those principles?
It's super hard. It is, even for me. So I've been thinking a lot lately about short-term thinking versus long-term thinking. And I, like my clients, invest in index funds, broadly diversified with 10-year outcomes in mind. But just like many of our clients, they want a little bit of, they call it play money on the side, right? Well, I just want to go buy this individual stock, or, I want to buy some cryptocurrency, or do something, that's riskier than we might put in their traditional retirement portfolio. And so I've certainly done that before, as have my clients. Now I can tell you, I have rarely seen over long time frames those play accounts do better than the traditional, allocation approach. And even in my own, I've had stocks that, I thought, oh, I'll buy this individual stock just for fun with a 10-year outcome in mind. And I had one that went up 400%. Now, do I change my mind and suddenly go from, oh, I bought this for 10 years and sell it right now if it's only been 6 months? And, in hindsight, I could say, yeah, I should have, because now it's not up 400% anymore. But it's back to, what were you thinking when you bought it? Did you put in writing? What was your time frame? So I think it can be very difficult to separate out, particularly play money from money that is dedicated to a bigger purpose, your future retirement paycheck. And maybe it's okay to apply different philosophies to those two different buckets, but you have to be really clear on your time frame, that short-term versus long-term thinking. And it's hard. It's very difficult. It's back to discipline and back to my own, my analogy around exercise. Who is going to keep you on track? I think that's a lot of the role that we play for clients, is making sure that they're focused on the long-term goal and they don't get sidetracked by whatever's in the media today.
Yeah. So Dana, what do advisors have to do differently?
Well, that's a great question. I will tell you what you as a consumer can do with your money that as an advisor, we really shouldn't be. Regulatorily wise, we can get in trouble. You can day trade. You can use technical analysis. You can follow some kind of a chart or market timing strategy. You can use intuition or guesses or a hunch, or just because your neighbor or your friend or your family member told you that you should do it. You can read a newsletter or a podcast or an article and say, I'm going to go do that. Now, as an advisor, some of those things we could do. If an advisory firm had a written philosophy that they were going to use technical analysis or charting or a certain type of market timing approach, as long as they disclose that to you, then absolutely they can do that. But they do need to follow some kind of a written approach. For advisors like our firm, where we're working with people's money they need to live off the rest of their life, we have to make decisions based on research. We have to disclose risks as well as potential returns. We have to make prudent decisions. We have to have a structure to the portfolio. What are the guiding principles that it is based on? We can clearly articulate why something is in a portfolio. There has to be a process that we use in going about whether we're going to add more of this or sell some of that. We have to base decision on a plan, and we have to determine the range of possible outcomes. So we aren't always certain. We can't guarantee an outcome, but we can have a range of possibilities and say, this approach we think is going to give you the highest probability of success. You don't have to do any of that if it's your own money. You can say, well, my neighbor said, I should buy XYZ stock, so I think I'm going to go put some money in it. So it is very different. You also have to consider in the industry, if you look at something like a hedge fund, they have a compensation structure built in that incentivizes them to take risk. So they get paid a lot more if they can have high returns. Now, of course, you make more too, but the downside to that is they can be incentivized to take risk and poof, lose all your money. And so I personally don't think that's what the average person should do with their money. You don't want to take that much risk. You need to live off this money the rest of your life.
Yeah. If you are going to invest in something risky, what % of the portfolio should it be?
It's a great question. We did a video last year on crypto, and we talked about crypto being this potentially new asset class. And at the end, what percentage should you invest? It was about 1%. And so it's interesting because I think it was the Bank for International Settlements is just coming out with a policy on banks and whether they can hold Bitcoin as reserves. And it was the same guideline they were looking at. I think it was 1%. And so when something is new or really risky, yeah, I think 1% is about the right allocation. Now, for something that is not as new, I'll tell you what I've seen a lot are private funds, private real estate funds or private lending funds. There was years ago where we had clients that we were recommending go into a certain private fund, and we had used 10% as our maximum guideline. Now, I had one client who was very nervous about traditional portfolio structures at the time. This was 2007. And so he decided he wanted to do more than 10%. And he went directly to the company and said, I'm taking all my money out of this traditional portfolio stuff and putting it all in this alternative investment. And it was a real estate deal that ended up going under with a real estate crash. And so, following those prudent guidelines is what saves you, right? In his case, if he had kept the bulk of his portfolio in this traditional structure, he would have been just fine. Yeah. He could have sustained a loss of 10% of his portfolio and still been just fine. And so you have to be careful with things that looks too good to be true. You don't go put all your money into them. That's where you really get yourself in trouble.
Yeah. So you must have some other tales of woe where someone was imprudent.
I do. I have one client who went to another advisor. She had $4 million and she was a widow with 4 daughters, and went to a firm that shared the same religious affiliation and ended up signing over all of her portfolio onto promissory notes. And it's really unusual, and those deals end up going under, or I'm not sure what happened. We had to send her to an attorney and pursue litigation. But again, a case of not following a prudent set of guidelines and a set of allocation guidelines on saying, okay, this is a riskier investment. The 2 most important questions you can ask: can I lose any money? And can I lose all my money? Well, on these types of investments, the answer to can I lose all my money is yes. Why would you ever put 100% or even, more than 90, more than 50%? I mean, any large amount, right? In something where you knew the risk was you could lose all your money. That is definitely not prudent. I've also heard stories. I was just talking to someone the other day, and their brother was doubling down on crypto, taking out a mortgage since crypto had come down off its highs to put even more money in. And so again, sure, you can put a small piece of your portfolio or your play money in these things, but to risk your entire house on something, that to me is the kind of things we hear about that just, they scare me.
Yeah. So I want to end with where we began, which is we're dealing with crazy headlines, and the best way to deal with those crazy headlines is to have a set of guiding principles.
It is. And if you can, tune out the headlines. That is the hardest thing with our devices. We have these headlines in front of us 24/7 on our computers. They're scrolling, they're constantly bombarding us. So how do you tune them out? I mean, maybe the answer is you write down your guiding principles on an index card and you make it just as visible as those headlines. You tape it to your computer screen, or you have it in a PDF or a note in your phone. And maybe that becomes a habit, so that anytime you're tempted to deviate from them, you go back to those guiding principles and say, wait a second, here's why I'm investing the way I am.